Hello, hello. Welcome to the Five Talents Podcast. I'm your host, Abel Pacheco. I interview the top commercial real estate investors and industry experts so you can learn from their experiences. So if you're an investor, a high W-2 earner, or real estate or tech sales professional that wants to invest in real estate without having to manage properties or leave your day job, then this podcast is for you. Or if you're already investing in real estate, but you're doing it part-time and you want to become a full-time multifamily or full-time commercial real estate investor, this podcast is for you too. You're going to learn a ton. You will learn from real-life multifamily investors and other professionals in the industry. They're going to share their blueprints for success, and I'm super excited that you're here. So I hope you enjoy the show. Hello, hello. This is Abel Pacheco, your host for the Five Talents Commercial Podcast. We are talking today with Mr. Anton Mattli. Anton, thank you very much for joining, my friend.
Yeah, thanks for having me, Abel.
Yeah, man. This is a treat having you on our show because, well, for me personally, I have heard you talk a number of times. When I first got started in the multifamily world, you kind of helped usher our team along the finish line, and we closed a big deal. And it was, one of my first ones. And you're helping me through, like, hey, here's your PFS, here's your stuff, put all this stuff together. And I'm like frantically trying to put it in my information. And you were there to help us close when I was, one of my first general partner deals. So now it's kind of come around. I'm having you on our podcast, which is really cool, Anton. Thank you very much, brother.
That's great. Yeah. And now you're not wondering, what is that, the PFS?
I know what a PFS now is, and I watch it closely every couple of months, man. So this is awesome. My REO schedule as well. I'm like, well, let's see it grow. But for those that don't know you, I do want to give a bit of background for Anton. So Anton is the CEO, founder of Peak Financing. He's got decades of experience in commercial investment banking. So basically, like, private equity, commercial real estate. He's, graduated from the Zurich Business School in banking, so international. He is from Zurich, Swiss, from Zurich, yes?
Well, I was born in Lucerne, but Switzerland is so tiny. It's essentially a little bit bigger than Dallas-Fort Worth, right?
Okay, got it. So from that, he's been really operating for the past 15 years, advising family offices, high net worth individuals, private investment funds, helping facilitate really just massive amounts. When I think of massive amounts, several hundreds of millions of dollars, and probably completed well over billions of dollars, like hundreds of multi-million dollar, if not, I don't know. I heard the number one time was 1,000. I don't know how many transactions have you done? And let me just turn it over to you now. Tell us about yourself and tell us about this transaction volume and tell us what you specialize in, and we'll kind of jump right in, Anton. But thank you very much for joining.
Yeah, sure. Thanks again, Abel, for having me. Mm-hmm. Again, right, with that strange accent, even though I'm based in Dallas, I've been living in Dallas-Fort Worth now for around 15 years. That strange accent is from Switzerland, as you said. Right after school, I joined what is known today UBS. So I worked with them in New York for 5 years, and in Tokyo for 4 years, Hong Kong for 3 years. And then I left the banking side and started on my own. And again, as you mentioned, working with family offices, high net worth, ultra high net worth individuals with, you can call it alternative assets or direct investments, whatever you want to call it, but it's essentially, it's all whatever is a non-traded investment. And it was involved in various type of asset classes, from oil and gas to manufacturing plants to, but commercial real estate was always a key piece of that, including multifamily, right? And I would say, even though we have been involved with on the financing side as well as helping on the investment side with all commercial real estate asset classes, including hotels and offices, industrial buildings, and all that. Multifamily has always been kind of one of the core pieces. And the reason for that is, when I look back, multifamily just has over the long term, just has one of the most solid track records that you essentially can achieve, compared to some of the others that have a massive up and down element to them. Right now, today, obviously, industrial is also a little bit of an industry darling. That was not always the case, right? So, whereas multifamily, I would say, has been mostly that stable ship on the rough ocean. So that's why I've always been pretty heavily involved in that segment.
Yeah, that's awesome to hear. So somebody like you and your expertise, you've advised, like we said, ultra high net worth individuals, but all the way to, transactions for Fortune 500 companies. So you've crossed the different lines, multiple different asset classes. Some of the similarities, it's all coming down to some kind of income or income generating asset, right? We're looking at, how do I invest my dollars? What's the best return? Where do I put it? Whether I'm a smaller entity or one of the largest, it's going to come down to, the numbers. How do the numbers look? And, you start doing this evaluation. That's where your expertise lies. And I love hearing that multifamily has been one of the core staples among the ultra high net worth or large entities, because that's as a little guy, I'm the little guy. I'm trying to put my money in someplace that I know it's already been proven, it's already tested, it's already trusted, it's a reliable asset class that I can try to make, the next comma in my net worth. And that's really, what we're trying to get to, right? So it's I think we have a lot of listeners that would value from this conversation, because we have passive investors that are trying to figure out, what to do with their money. And then I think we also have a lot of good, general partners that maybe it's their first, second, third deal, and they're trying to learn more. So this is very, very timely conversation, especially with COVID. So we record this in October, at the end of October 2020, and things are a little crazy. Things are better, but we're about to hit our our election time right in November. So I think this will get released right after. We'll see where we're at. But why don't we talk a little bit about, first starting at the basics, right? When I buy a multifamily deal, $10 million property, let's make the numbers round. What does that mean as a buyer? How, do I have to have $10 million? No, there's a percentage that I have to put down, and how much money do I need, and how do I qualify, and what's the best way to say, hey, how do I go buy a deal? Maybe just give us a really short snippet of that, because I have a lot more questions, but let me start there.
Sure, yeah. So obviously what you touch on is really the benefit of leverage, right? And that's what commercial real estate is really all about. Even for institutional investors, they may not push the leverage that high, but virtually everyone comes in with 50% leverage, and you can go all the way up to 80% leverage, right? So out of the 10 million, your down payment may be 2 million in the best case scenario. There are some exceptions where it can be even higher, but for most loan programs, it's capped at 80%. But depending on the market, it might be only 65% leverage or 70 leverage, you name it. What is important also to understand is it's not just your down payment, right? You need to bring in various escrow monies right now, and we can touch on that a little bit later with Fannie and Freddie as well as HUD. We have the principal and interest escrows that they want to put into escrow to have an additional cushion in case COVID-19 flares up again and performance at the property comes down. But it's also for other items like taxes, for insurance, for potential capex, for some immediate repairs, and also for you as an operator, just operational expenses, right?
A little bit of cushion.
Yeah, that's right. So I would say it's probably, if it's a 20% down payment overall, the cash that you need to bring to a table for a 10 million deal is probably, depending on the condition of the property and situation, 2.5 to 3 million, right? Rather than just that 2 million, that is the actual down payment. So it's important to recognize it's not just the down payment, but there are many other elements that need to be added to that.
Yep. As a new general partner or a passive investor, you're looking at a business plan and you're saying, oh, there's your value add. That means interior unit renovations, a new floor, and new fixtures, new paint, new cabinet painting and everything. You got a little deferred maintenance. Well, where are you going to come up with that money? You got to put that in there. It's not just the down payment, but your capex. And so anyway, we roll that all together, and that makes a lot of sense. So I could come out with $3 million, and if I have the cash, that's not all I need, right? I need to have a little bit of maybe experience, be local, a property management, maybe describe just a little bit of that as well. And then, we'll move on to this next point.
Sure, yes. So it's only important that someone brings experience to the table. In the past, it was a little bit easier with particularly Freddie SBL, when they allowed to have inexperienced operators to buy their first multifamily property and get a Freddie SBL loan. That essentially is now out the window. They have actually tightened up their standard requirements, where you need essentially 3 units, multifamily units, that you will qualify for a Freddie SBL. So now their standard is actually tighter than for Fannie. Before it was the opposite. Can you make exceptions? Yes, but generally that's what they expect. So in summary, you should bring some form of multifamily experience to the table. If you do not have it, partner up with someone who has it, right? Mm-hmm. So that's on the experience side. They prefer third-party management in most instances, unless someone already has multiple properties that they self-manage of a similar size and in that market. Now, from the financial experience side, it's important to recognize that, unlike on the residential side, where it's all your personal cash flow, it is your net worth on one hand, as well as your liquidity, that matters, right? So as an example, to bring up again that $10 million deal, let's assume that you get to the maximal leverage of 8 million. The team together, not just you yourself, but the team together would have to come in with a net worth of at least 8 million. Mm-hmm. And the post-closing liquidity, as we call it, that means after down payment, after all the funds that go into escrow, that you need to still have as a guarantor group or sponsor group, key principal, as we call them, should be roughly speaking 10% plus of that loan amount. So it would be 8 million net worth, minimum 800,000 of minimum liquidity.
Yep. Okay, got it. Yeah, so we have the experience, and the way, when we first met, I borrowed my partner's experience. He had already had signed on loans. He was already operating. So it was easy for me to get my card punched, as they say, on my first opportunity. And it was like, okay, great. I'm moving forward. Now we had, the net worth, we had the liquidity. We didn't have $3 million. We raised the capital from our investors, $50,000 at a time, and we pulled it together and did a syndication, and we go forward, right? And so for those listening, it's really a systematic process. It's not a question mark, like, I wonder if I can get in this deal. It's like, no, if you have the components, just like you're baking a cake, if you got the right ingredients, you can, follow the path, you're going to get the deal. You want to look for the right one, the right market, the right team, the expertise, and you have money together and you go do the deal, right? So it's that systematic process that, somebody like an expert like Anton really helps us through to make sure we're, have our sights set in the right target, and then, basically obtain the money, right? So that's awesome. So now moving forward a little bit, deeper into today, right? Yesterday, Fannie, Freddie, agency, bridge, which maybe I'll have you touch on a little bit. And then today, COVID, post-COVID, we've experienced the markets tightening up, especially in March and April. They tightened up, deal flow stopped, the lenders stopped for some period of time, and then the deal flow started happening again. People started listing their properties, the banks started lending again. Maybe describe, a little bit of the agency debt before COVID, and then what's happening now. And we could probably go into multiple different topics through this discussion.
Sure. Yeah. Pre-COVID, agencies certainly have already started to tighten up a little bit. That's more obviously they didn't know about COVID at that point, but they certainly were a little bit more concerned about overall situation in the multifamily market, right? When you look back where prices were 10 years ago, right, when we essentially were at the bottom of multifamily prices after the Great Recession, we now have seen price increases that have been extremely substantial. Cap rates have contracted. Generally, it has become much harder to get to a maximum leverage with the typically minimum debt service coverage of 1.25. There are some exceptions depending on the market, but overall, it only has the underwriting, even the standard underwriting essentially resulted in that it has gotten much tighter, right? When in the past it was relatively easy to get to an 80% leverage and still have a little bit of a cushion in your debt service coverage, or you could build in some rehab money for Fannie loans. That essentially hasn't happened over the last 2 years because prices have been pushed up so much, right? You have a large supply that comes in, but the buyer demand was just out of this world. And as a result, Fannie and Freddie obviously have seen, look, I think things get a little bit too aggressive here. We need to tighten it up a little bit, right?
Yeah.
So
they're trying to slow us down a little bit. You guys are paying way too much. We don't agree. We don't agree.
Right.
It's the end of the 10-year cycle. We didn't know COVID, but like you said, it's the real estate market cycles go up and down, and people had kind of been feeling that we're at the top of the market. Let's cool this thing off.
Yes.
Okay.
Yeah. So on the conventional side, what they did essentially pull back with their interest only levels that they were willing to grant until 2 years ago, right? Where it was virtually every single deal, as long as it underwrote right, you were able to get 5 years plus interest only, right? Which was obviously great, but they realized, I think we need to tone that down a little bit, scale that back. And on the Freddie SBL side, as I mentioned earlier, they also increased their requirements when it comes to sponsor experience, and they also limited some of the cash out ability, so that that someone cannot significantly cash out at the full leverage. So they did that already pre-COVID, right? So as we then entered into March, when all hell broke loose, obviously that also had an impact on the agency loans, right? It had a very brief impact on deals that needed to be funded right during maybe a week period in mid-March, when things were really bad, when some lenders didn't get access to their warehouse loans and all that. Even though they had all the commitments issues and all that, they just didn't have the funding right at that point. But to the most part, all the loans still could be funded and things could be done. Unlike on the CMBS side, where everything essentially fell off the cliff. A lot of bridge loans didn't close, a lot of CMBS loans didn't close, because everyone then essentially came to a complete halt. They didn't do anything. So on the agency side, it was much better than for every other one, except maybe banks that all still were able to do it. So that was during that rough period. Now, obviously, Fannie and Freddie very quickly then implemented their emergency mode, meaning that, look, we are continuing to lend, but I think we need more of a cushion, right? So then they start to implement, okay, now you need to come in with principal and interest escrow, insurance, taxes escrow, everything that they potentially could find that could be escrowed. They wanted you to escrow up to 1 year. Yeah. And that lasted maybe for roughly a month or a month and a half until they scaled back. And now what we are still left with, which is still pretty hefty, are the principal and interest escrow requirements with both Fannie and Freddie. And depending on the loan program and depending on the leverage, it still hurts, right? If you're a sponsor, whether you're a syndicator or not, it still hurts because yes, you get that money back at some point, but you do not have access to the money for, depending on the loan program, for, I would say, at least 3 months in a best case on the Freddie side, but realistically it's more 6 months plus, and on the Fannie side 12 months plus, right? So
yeah. And then as a passive investor or a syndicator in either area, if your syndicator or sponsor is having to raise more capital to put down into the loan or in the escrow, not in the loan, but to close, right? It's in escrow, we can't touch it. The more capital we raise, that means the lower our returns are gonna be to investors. We have to pay that money back with interest. Nobody's lending us money for free. And then the passive investor, you're like, yeah, you guys go deal with it. Okay, well, we are, but our returns are adjusted also as a passive investor. So yes. It reduces our cash on cash return. If I had less cash and I could get a better return on my investment. So anyways, yes. This is kind of the impact there, right?
Yeah. So obviously that's all correct, right? Mm-hmm. At the same time, right, and obviously that comes with a little bit more with my institutional background. As a passive investor, you should not really focus solely on that return that goes down, but you also should look at your risk-adjusted return, right? So me personally, I would rather invest with someone that has a year cushion of principal and interest and are willing with that to accept a lower return than someone who doesn't come in with that additional year of a cushion. Now, even if you do not need that cushion, right, and you have that cushion in your own bank account rather than in escrow with your lender, I still would feel more comfortable with a GP that actually raises that 12 month rather than saying, well, I decided not to go with a Fannie loan because I would have to put 12 months in there. So I went with whatever bank loan or whatever it is, so that I do not have to put in the 12 months, right? So that's kind of a statement that from a passive investor perspective, does not really make sense. It only makes sense when you disregard the risk aspect. But once you apply some form of a risk adjustment, mm-hmm. and it actually, you can argue that it's better. Right?
What a great point. So I'm glad you're talking about this, and thank you, because this is, there's a difference between my leverage. If I borrowed, I pushed the leverage, the LTV as high as I possibly could, and borrowed at 80 or 85, like you're saying, you could push that, or if I only pushed it to 60% LTV, then one provides me a higher debt service coverage ratio, a safer asset, or safer risk adjusted, because I have less of a chance of all the renters leaving my property and still being able to make, the payments and not, the institution, the lender, take my asset back, right? Hello. You're listening to the 5 Talents Podcast. I'm your host, Abel Pacheco. If you're enjoying this podcast, then I know you're serious about achieving financial freedom. Are you ready to create your own path through multifamily investing for yourself and your family? Then I know you're going to appreciate our Investor's Guide to Multifamily Investing. It's titled Tackling Commercial Real Estate the Easy Way. We use this guide to invest ourselves in $93 million worth of real estate. So we're going to show you the basic mechanics of multifamily syndications, and how to evaluate your next passive investment opportunity. So the best part, if you subscribe to our podcast now, leave us a review and a rating. I'm going to give you a free copy of our ebook. So please take a moment to do that now. Once you've done that, go to 5tcre.com/ebook, 5tcre.com/ebook. Make sure to let us know you left a review, and we're going to send you a free copy. So thank you so much for subscribing to the 5 Talents Podcast. We really appreciate it. So let's stay here for a second if we can, Anton. For the passive investors, this is really, really good. What's debt service coverage ratio? What does loan to value do for the properties? And when you say risk adjusted return, one deal versus another, a lot of times as a passive investor, I'm kind of trained, here's my average annualized return. And it's 16% on one pro forma, but then when you look deeper, it's like, you didn't normalize this or that, or the assumptions are off. And so who cares what the adjusted rate of return says? I should be looking this way. You've got a ton of experience, Excel, spreadsheet, financial analysis, just for entities. Help the passive investors right now, just kind of looking at deals, evaluating properties, looking at the pro formas and the numbers. And we'll stay here for a second. What do you think?
Yeah, sure. To come back to your first question, right, about the debt service coverage, it's really a question of to what extent is your NOI, your net operating income, covering the debt service, right? So now, as a kind of a standard starting point for most of these multifamily loans, so only with the agencies and to a large extent also with banks and CMBS loans, is 1.25, right? So what that essentially means is that the NOI has a cushion of 25%, right? The 0.25 times of the debt service. So you essentially can say it can go down. Let's say you have an NOI of 125,000 and the debt service of 100,000, that NOI could go down by 25,000, and then you will be just at 1.0, and you still will be able to cover that, right? So obviously, if you have, let's say, 135,000, so then your debt service coverage will be 1.35, and 150 it will be 1.5. So naturally, with that logic, with the higher that debt service coverage ratio is, the larger your cushion is, right? And the smaller it is, obviously the lower your cushion and the higher the risk it is. So that brings me then to the other point. Obviously, that's a little bit tough, right? As a passive investor, particularly when you are not coming from a financial background, but you need to find a way to stress test your investments, right? And the investment proposal by the sponsors that present you that deal with. Some sponsors present you with stress test scenarios, others do not. I would say we still, particularly in the private syndication space, I would say we see a majority that do not really present a true stress test scenario. They talk about at very high levels, but usually it's up to the passive investors to figure that out. And obviously, if someone comes in with a maximum leverage as a passive investor, you need to recognize that you essentially have a cushion of 25%. But if someone comes in with a deal that allows a debt service coverage of 1.35, your risk is lower because that cushion is higher, right? And again, right, there is no set rule. Well, if it's 1.25, what should my return be, right? So for you, it might be different than it's for me, and it's for the third person, right? So everyone has a different view of what their return should be. But for every single individual or institution, they should implement a table where they say, for the highest risk, I need to have that return. For the lowest risk, if you say, okay, U.S. Treasuries are my lowest risk, that's where your return is, right? And then you have anything in between. And I would say that is the main problem with a lot of passive investors, that they just say, well, I need to achieve my 8, 9, or 10% cash on cash return, but they are not really digging deeper and compare one deal with another and determine how much more of a return do I really need for this deal that I'm willing to go in. Yes, it says 10%, but that other deal at 7% might be much better from a risk-adjusted perspective.
The table that you describe is something that sounds amazing, right? Because there's all these other investments, not just multifamily real estate, and you can literally map those out and say, oh, this is the risk and this is the return on one scale, on one hand, and then the other side of the scale is the other, higher risk, low, higher return, and everyone's kind of somewhere in between those. And if you map those things out, you can literally see, and then one deal versus another deal. And then for those passive investors that are kind of, maybe having a little trouble following the debt service coverage ratio, I think the description that you said was like spot on. The numbers was perfect. That debt service coverage ratio, just like your single family house, your mortgage payment is $1,600 or $1,700, whatever the mortgage payment is, multiply that number times 1.25. And that's how much the spread or the difference is what the bank wants you to have is income coming in the project to say, yes, you can cover the mortgage plus that 25%. And the higher the debt service coverage ratio, the more profit, the more NOI is coming in to cover that. And that's what, we all want, is a ton of NOI way above beyond the debt service, right? So that's that ratio. And
sure,
that makes a lot of sense.
And when you look back into the Great Recession, right, the ones that had a stronger cash flow were the ones that were more likely that they had the ability to get through that period, right?
Yep.
Also, the ones that were unlucky enough that they had to refinance exactly during that time, right?
Mm-hmm.
Because the cap rates moved up dramatically for during that period. So you needed to have a strong cash flow even to support that original loan amount, right?
Mm-hmm.
So it's a combination still of leverage and debt service coverage, right? That is really important.
Actually, yes. So 100%. And I'm nodding because I'm excited to ask you my next kind of question. What was the difference between what was happening in 2008 and what's happening in the financial markets now? Or, put on my investor multifamily hat. What happened then and what's happening now? And what can we learn or say that this is completely different or this is the same and this is what we need to take from that, if you can kind of help us with that.
Yeah, I mean, in the multifamily space, right,
Mm-hmm.
CMBS loans were really had a very strong position, and the underwriting certainly was more aggressive than it is today. It was much more common to underwrite to some form of a pro forma, right? So today we still underwrite to pro forma, but it's essentially reserved to bridge loans, right? To true value add loans. Whereas back then, it's only for CMBS loans because the investors were there that were willing to accept that risk. You could push the valuation based on some forward-looking numbers, right? Which obviously, as things then fell apart, these loans didn't last for too long, right?
Yeah.
So I would say that was really the biggest difference. And back then, similar to what we have seen now over the last few months, the agencies really came to the rescue. They were the ones that were able to lend during that period. If someone was able to come with sufficient cash to the table, or if someone already owned the property and was able to get additional equity in, right? So even though the agencies were willing to lend, if the property value dropped, it didn't really help to have that agency loan as an available option unless someone actually was able to bring additional cash to the table, right?
Mm.
So it was certainly a much more distressed situation back then than it is today. On the multifamily side, we haven't really seen any significant distress over what we have seen in March into April, and then everything essentially disappeared. We do not have all the lending programs available, but at least the properties have performed well above expectations. The valuations haven't dropped that much, right? So now the perfect storm is outside of multifamily, but more is in hospitality. Obviously, they are
Hotels are getting hammered, and geez.
Yes. So hospitality is only in top. Retail, depending on what type of retail it is, also is getting hit extremely hard. And then to some extent, offices. I think offices we haven't really heard the end of it because it takes a little bit more time. But certainly in particularly hospitality and retail, it has been a bloodbath and it's continuing to be a bloodbath there.
Yeah. How okay, so that makes sense, right? Back then, writing to performas, people didn't hit the performa. It just wasn't equating. There's distressed properties, things unfortunately had a bad ending, right? Now today things are performing. They're performing kind of, at least, we're talking about multifamily. They're performing well. People stay, shelter in place. I don't want to lose my house. I got to make sure I'm paying for the roof over my head, and I live in an apartment. Let me make sure this thing's getting paid. And so for the most part, we haven't seen that distress to date, and God willing, we don't see it in the near future, right? But the other side, hotel, hospitality, retail, that kind of stuff, is getting hit. How is there any maybe talk about the correlation or the cap rates over there versus multifamily? Does it have an impact, or is it completely unrelated, or
I mean, we haven't seen much trading in the hospitality space, right? And the few that are being traded, it's not even fair to apply a cap rate right now.
Okay.
Right? I mean, if you have a property that it has a historical occupancy of, let's say, 70%, and now it's at 30 or 40%. Could you technically apply a cap rate to that today? No one is selling unless they have to, right? So it's really hard to truly apply a stabilized cap rate, and the few deals that trade are mostly distressed, right? Or a lot of loans are renegotiated. That's really where most of the attention is.
Okay. Yeah, it makes perfect sense. So now, as we're thinking about multifamily today, we, as a buyer, I say we were hoping for the prices to come down, for us to say, oh man, there's going to be some properties on sale now, and I haven't seen that yet, and maybe I haven't looked at enough properties, but on my buddies that I'm talking to, no, the prices are actually holding firm. If anything, they're getting more aggressive, and I see cap rates are dropping, at least in our offer, or the requested price. My offers are not that, but anyways, in the properties that you see traded, what's going on in multifamily, like right now, today, in the markets that you're familiar with, in those cap rates for multifamily.
I mean, we have seen rises of deals that were already under negotiation, or they fell out of a contract, right, because of the financing piece or whatever. We have seen some price reductions somewhere in the 5 to 10% range.
Okay.
But I'm not sure that we still have that today, right? So that was kind of in in May and June, maybe into early July. And then everyone recognized, well, we still can collect rent. So sellers essentially said, well, we are not willing to sell at the discount. However, there are still deals that were very aggressively priced or that fell through and they tried to negotiate and that they have been in the market for maybe 3 or 4 months already. That's where we see a little bit more of pricing discount. So I would say there's only some where we have seen maybe 15% of a lowering of the price. But that's really more the exception than the rule, right? So overall, haven't really seen that much. I would say the storm is not over yet, right? We have to see how the new stimulus package, assume that once the election is over, they come back together in Washington, right? Rather than just disappearing, right, what they did yesterday and say, now we are going to campaign for the next week or so.
Sure.
Obviously, they will come back. They will discuss the stimulus package and something will be put into place. So I think short term, that will help. Medium term, I'm still not sure because I would say unemployment will still be elevated for some time, and I think there will be some stress in rent increases. So I'm not sure that the true storm for multifamily has passed. So I would not be surprised if we still see some price adjustments next year, right? So I would say the true test is really next year, and I personally expect that we will see some more distressed assets that will come to the market, which then has an impact on the overall market sentiment. We also should never forget that we are not in a vacuum, right? As things settle down, there will be opportunities on the retail side, hospitality side, in other areas. And ultimately, everyone is looking for yield, right? So if you're an institutional investor, you may say, well, I had X amount allocated to multifamily, but now I see all these opportunities on the hospitality side or retail side, whatever it is. Let's shift some of that over there.
Yeah, right? Eventually it's going to come back. And if we can ride out the next few years, well, I can get a property on discount over there.
That's right. Yes. Yeah.
Yeah, that makes sense. Okay, well, this is awesome insight. So let's, if we can, talk a little bit about today's current state, right? In lending, it's the agency, Fannie, Freddie, HUD. The difference between a bank loan. If I'm a buyer, maybe touch on each one of these and say, hey, these are the types of loans you should be using for this type of asset or this type of acquisition. And, maybe break that down just at a little bit of high level. How do I know what loan type to use? And, this is also me kind of pointing back to your expertise. This is why we would use Peak, but tell us a little bit about that world.
Sure. If a property qualifies for an agency loan, go for an agency loan. That's really my view on it, right? So there are some exceptions. If there is a property that underwrites extremely well with in-place cash flow, you can qualify for an agency loan, but you as a sponsor feel I still can raise rents by $200, $300, then maybe you say, look, I think I may want to go into a bank loan or maybe a bridge loan because I have that massive upside. These are exceptions to the rule. And in most instances, these expectations are probably too inflated to be really realistic. There are not really that many deals out there that still have that massive upside built in for a stabilized property. So that's in reality, most likely than not, if it's a stabilized property, an agency loan, Fannie, Freddie is ideal. Obviously, you need to come with expertise, the experience to the table, and if not, partner up with someone who has it. For deals that do not fit that box, CMBS has started a little bit on select cases. I generally advise not to go with the CMBS loan if it can be avoided. But if someone really wants non-recourse and the agency is not available, then maybe. If it's a true value add, obviously you have the bridge loan space. It was extremely aggressive until COVID-19 hit. The market was flooded with bridge money, really cheap money. That's only had the spreads have increased there, so it's no longer as attractive. Players have moved out. There are still a good number of bridge lenders, but they are much more selective whom they want to finance as a sponsor for a property perspective market. So they are much more picky. And if that doesn't fit into that box, then maybe a bank execution is really the only option. There, I would say, apart from the fact that it's a recourse loan, has lower amortization, lower terms, shorter terms. It's not necessarily a bad thing to do, right? Obviously, everyone is scared about that recourse piece. My view is if the deal is really good, maybe you need to think why you are still not comfortable with a recourse loan then, right? So if it doesn't fit into the agency box, so obviously there are some issues. Maybe it's too small, right? Which is also a higher risk proposition when it's a really small deal, or it's not fully stabilized, whatever it is. So then you have to wonder, well, if I go with a bank loan, maybe I need to lower that leverage, what we discussed earlier. And once we have sufficient of a equity cushion in there, if it's a 70% or 65% bank loan leverage, I think I might be comfortable, and my partners that co-guarantee with me might be comfortable too, right? I see a lot of sponsors pushing at any cost to go into a bridge loan because it's so-called non-recourse, and they regret it within a few months, right? Just because it's non-recourse doesn't mean that they cannot breathe down your neck, right? They can ask for more interest reserves. If you do not perform well, they may withhold rehab money. They may ask for more equity. There are a lot of things that they can do to make your life miserable. And if you went with a bank, yes, it may have been recourse, but you would have slept much easier at night, right? So I'm not advocating not to go with a bridge loan, but I really suggest to only go with a bridge loan for experienced operators. Right? Because banks are just much easier to deal with, particularly if things do not go exactly perfect.
Yeah, and as a borrower, how in the world do I know I'm getting the best? I'm using the right loan, I'm using the right, and I'm at, kind of turning this over a little bit. How do I make sure that I'm getting the best deal no matter what I'm doing?
Yeah, I mean, that's the tough part, right? That's why we exist. That's peak financing. We are intermediaries, right? We are debt capital advisors, right? So we match the sponsor with and the property and the market with the right lenders. So that's the first step. But then we also, once a lender is chosen and it goes under loan application, we make sure that that loan actually can close as applied, right? So we make sure that the property condition assessment doesn't come with ridiculous immediate repair requirements, that the appraisal comes back where it should be, also from an expense perspective, and all the way to the end when it comes to the rate lock. Like Freddie SBL, you essentially have the rate guarantee, but for most of these loans, Fannie and Freddie conventional loans, the rate lock is really the time when your true rate is locked in. So even though you may apply, let's say, for a 3.5% interest rate or 3% interest rate, that's not guaranteed until the rate lock. And when you read that loan application, then you see the fine print when it says it's an estimate and it can fluctuate, right? So we as intermediaries, we make sure that the lender is not padding the spread that they add to the underlying rate, in most instances the 10-year treasury, and that you actually get the most favorable rate.
Okay, yeah, because if I, let's say I've done a number of deals and I feel pretty comfortable in what type of, I want to use agency and non-recourse debt, I kind of fit within the bucket, I have experience, all that stuff. If I try to do that on my own, I'm not sure, if I'm really getting the best deal, or as opposed to intermediary, I'm going to bring it to you. You kind of see all these things happening and you're going to, basically fight for me.
Yes, that's really what it is, right? So again, taking that 3% example, it's a large loan, right? So at that point when you applied, they offered a 3% in all-in interest rate, right? So now it comes to the rate lock time, and your lender tells you, well, it's now 3.10% because the spread has increased or the treasuries have increased, whatever, right? So how do you know when you do maybe half a dozen deals, most operators do not more than that per year, whether that 3.1% all-in rate that they're quoting you is really the best rate that they potentially could give you, right? You do not know. We know that, right? Because we are in the market on a daily basis. Also, if you had an original quote of 3%, and it also can happen that the spreads actually narrow, right? That the rate could come down. So, do you think if you are not active in that market on a daily basis, if the lender potentially could give you a rate of 2.9%? Would we know that? More likely than not, the lender will stick to the 3% that you originally quoted in the loan application and pockets that 10 basis points, which essentially translates into an additional compensation for the lender originator of almost 1%, right? So it's a very attractive compensation to the lender that they are essentially just padding the spread because you do not know better, right? So that's where we come in.
I understand.
You keep the lenders honest.
Yeah, I love it. Well, this is why I trust in Peak Anton and joining up on the team, man. That makes perfect sense. So I appreciate it. Is there anything we haven't touched on, man? There was a bunch more stuff on my notes that I wanted to ask. The time flew by more quickly than I thought. But is there anything else that we didn't cover that you wanted to talk about, or I didn't ask you about it, we didn't discuss, and anything before we go? We're pretty much
I think we covered a lot. Obviously, there are so many various aspects, right? Little details that are important, but I think we covered quite a bit.
It was a good conversation. Thank you very much for your time, Anton. I look forward to part 2 sometime. We'll dig in even further, and I appreciate it, everything that you do, Anton. So if anybody wants to reach out to you to get into your world, to get some help with some loan broker assistance, and you to serve as their intermediary, how can they reach out to you?
The easiest is probably by email. My email address is anton@peakfinancing.com. So that's ANTON@peakfinancing.com. So that's the easiest. But I'm also very active on Facebook. You can look me up there, on LinkedIn. So pretty easy.
All right. That's Anton Mattli with Peak. Thank you very much, Anton. I appreciate your time. And I'm Abel Pacheco. I'm your host of the 5 Talents Podcast. Thank you very much for your time. We'll hope to see you on the next episode. Thank you for listening to this episode of the 5 Talents Podcast with your host, myself, Abel Pacheco. Each week, we're going to bring you interviews from industry experts and commercial real estate investors who followed their dreams and achieved massive success. Before you leave, let me ask you a few questions. Did you enjoy this episode? Did you learn something valuable? Was your mind stretched to what's possible and what you can achieve? Do you want other experts just like the one you heard today? If you answered yes to any or all of those questions, then please take a moment to subscribe to the 5 Talents Podcast, give us a 5-star rating, and most importantly, leave us a written review. Tell us what you liked, tell us your favorite guest, Give us any feedback. I'm excited to learn and improve so you can get a more valuable show. So thank you again for subscribing to the 5 Talents Podcast.